Are regional bank woes the next big market headache? The stock market is sending a shiver down investors' spines, and it's not just the usual suspects causing the chill. While tech giants and AI darlings often grab the headlines, this time it's the seemingly quieter world of regional banks that's stirring up trouble. But here's where it gets controversial. Are these concerns overblown? Or is this the canary in the coal mine, signaling a deeper issue in the financial system? Let's dive in. U.S. stock futures dipped slightly on Thursday evening, extending the previous day's sell-off, fueled by growing unease about regional banks' lending practices. Think of it like this. Imagine a group of friends lending money to each other, but one friend starts handing out loans without checking if everyone can actually pay them back. That's essentially what investors fear is happening with some regional banks, and it's making them nervous. This anxiety translated into concrete numbers. Futures tied to the Dow Jones Industrial Average slipped 102 points, 0.2%, while S&P 500 and Nasdaq 100 futures both fell more than 0.3%. Even companies reporting strong earnings weren't immune. Interactive Brokers Group, despite exceeding expectations, saw its stock drop over 2% in after-hours trading. Similarly, Oracle, the cloud computing giant, dipped more than 2% after sharing its long-term financial outlook. And this is the part most people miss. The ripple effect of these bank worries is spreading. Drug makers Eli Lilly and Novo Nordisk also took a hit after President Trump hinted at negotiating lower prices for their obesity drugs. Wednesday's trading session painted a bleak picture, with all major U.S. stock indexes closing in the red. The Dow shed 301 points, or 0.7%, the S&P 500 lost 0.6%, and the Nasdaq Composite dipped 0.5%. The culprit? A sharp decline in bank stocks, particularly regional banks, after Zions and Western Alliance disclosed bad loans. This sparked fears of lax lending standards and the potential for more such issues to surface. The SPDR-SP Regional Banking ETF, KRE, already down for 4 consecutive weeks, plummeted over 6% during the session. Adding to the unease, the SIBO Volatility Index, VIX, often called Wall Street's fear gauge, jumped, while Treasury yields and the U.S. dollar fell. Meanwhile, gold prices hit record highs, indicating investors are seeking safe havens amidst the uncertainty. Liz Ann Saunders, chief investment strategist at Charles Schwab, pointed out on CNBC's Closing Bell that these banking concerns come at a time when there's a lot of speculative froth in the market. Investors are chasing risky bets like quantum computing, drones, and unprofitable tech stocks. When you have that speculative froth, and then you have a bigger picture potential issue, those two can sometimes collide and cause an increase in volatility, she explained. Interestingly, she noted that this froth isn't concentrated in the biggest companies anymore, but rather in smaller segments like the Russell 2000 Index, which hit a new high on Wednesday. But is this just a temporary blip, or a sign of something more sinister? The ongoing U.S. government shutdown, now in its 3rd week, isn't helping matters. It's halted crucial economic data releases, leaving investors in the dark about the broader economic landscape. Tensions surrounding global trade, inflated market valuations due to the AI boom, and the shutdown's economic impact continue to weigh on the market. Despite these headwinds, the S&P 500 is up nearly 1.2% for the week, thanks to a strong start to 3rd quarter earnings season. The Dow Jones Industrial Average has gained about 1%, while the Nasdaq Composite is up 1.6%. After Thursday's market close, some companies made headlines in after-hours trading. CSX Corporation, shares of the railroad company jumped 2% after reporting strong quarterly results, beating earnings expectations. Interactive Brokers Group. Despite exceeding earnings and revenue forecasts, the stock fell nearly 3%. This could be due to investors focusing on potential risks in the financial sector rather than strong individual performance. Oracle shares dipped 2.4% after providing its long-term financial outlook, which included a projected 31% compound annual growth rate over the next 5 years. So what does this all mean for the average investor? The situation with regional banks is definitely one to watch. While it's too early to panic, it's a reminder that even seemingly stable sectors can face challenges. Are we witnessing a localized issue, or is this a symptom of a broader problem in the financial system? What do you think? Let us know in the comments below.